afternoon. Thank you for joining us. My name is Marina Poljak. I'm the event coordinator for the Windsor-Essex Regional Chamber of Commerce. We'll get started with our webinar in just a moment. We'll let all of you log in and settle in. In the meantime, you'll notice if you have any questions or feedback for the Chamber, please send them to info@windsoressexchamber.org. And for COVID updates and helpful resources, visit our website. We have a COVID-19 tab that we update on a regular basis when it comes up. Also, follow us on social media for the latest updates and what we have coming up on Twitter, Facebook, and LinkedIn and Instagram. I've posted all of our handles in the chat section, as well as our email address, so you can grab that. You can view all of our previously recorded webinars on our YouTube channel, which is also linked on our website. Please note that you can leave questions for our guest speaker in the chat or Q&A, and we will monitor those and take them up. And we will get started in just one moment. Okay, Rakesh, I'm going to hand it over to you. And this is our President and CEO, Rakesh Naidu.
Thank you, Marina, and good afternoon, everyone, and welcome to today's webinar. So as you know, there is news that in few places in the province, it's been phase 2. So there is a reopening of several sectors that has happened, which is good news. And there is, unfortunately, not that great news for the Windsor-Essex region. We are disappointingly not yet in the phase 2. And that's something which a lot of businesses have conveyed to us has been extremely challenging, because most of us have been looking forward to reopening when it was announced a few days back. Having said that, the Chamber has been very strongly advocating and has been very active with getting our message across to the province that we are ready here. Our businesses are ready. We've had very low rates of infection. There has been some anomaly in the last few days because of some hotspots in some particular sector. Notwithstanding that, we've had very low infection rate, and thankfully the fatality number has remained at 67 for quite a few days, which is a great trend and great news for our region. So we are hoping that the province will take the right steps and get the Windsor-Essex region, move the Windsor-Essex region into the phase 2. So as we wait for that to happen, I think it is important that we in the business community take this time to be fully prepared and be ready, so that whenever we're given that green signal, we move quickly and reopen our businesses. Many businesses have indicated to us that it's not going to be that easy reopening for multiple reasons. The cost of compliance is one that is going to weigh heavily on businesses. The reduced business volume itself is a concern, and then access to employees has been identified as an issue. Almost 25% of the businesses that were surveyed mentioned that getting people back to work is becoming a challenge. So that's something that we are looking at very closely and doing our best to address this issue with multiple partners, even in the task force, the economic task force that's been constituted in the Windsor-Essex region. So stay tuned for that. There are several measures that are in place. Daycare and ensuring that workforce is ready is going to be critical as we reopen. There's also some concerns in terms of the employee wage subsidy program. The government intends to make this available for at least till the end of August. But unfortunately, there hasn't been a great uptake. Only $10 billion of the allocated $73 billion has been taken up as yet. So clearly there's been some challenge in terms of employers taking advantage of this program. So the Government of Canada is very interested in to learn about how the program can be improved, what changes, what tweaks can be made. So the Chamber of Commerce is going to be hosting a roundtable with our government folks, our MP Eric Kusmirchik, and potentially another minister from the federal government. So if you are interested in providing your input into that roundtable, and if you're a member of the chamber, if you'd like to participate, let us know. And if you're not, but would still like to provide your input, feel free to send us your comments, questions, concerns, feedback to info@windsor-essex-chamber.org. And Marina will put that email address on the chat as well. So we look forward to hearing from you so that we can provide this input so that the program can be further improved. And as I mentioned, we need to be ready so that we can move forward quickly as we get the green signal to, to get into stage 2. So to that effect, the chamber has been working with the Windsor-Essex County Health Unit. There are many sectors. Some of them are right now allowed to open, and some will be allowed to open when we get to stage 2. So for these sectors, we are creating a sector-specific checklist. You can access that on the Chamber's website. This is a guideline document for you so that you can use that and ensure that you're complying with the requirements that is laid down by the Health and Safety unit of the County Health Unit. And then finally, there is also a support for small businesses and for local businesses. The Chamber has partnered with TWEPI, Tourism Windsor-Essex Pelee Island. Supporting local businesses is extremely critical, extremely important for any economy, more so in today's time. A survey recently done found out that 78% of Canadians would like to support a Canadian company and a Canadian product, and that's a great sign. So we want to make sure that even in our region, our companies have the opportunity to offer their product and services locally, and our community has the opportunity to find out who are these businesses and which product and services are there that they can go out and shop, whether it is, the corner store, whether it is the bicycle shop, whether it is the florist, whether it is, the farmer's market. All these businesses are there and they have tremendous product, great service they provide. And I think it is incumbent upon us to go out and support them, whether you walk to them, whether you drive to these businesses, or whether you shop online. Make sure when you shop online, you're picking a local company that you're shopping from and that you're supporting. So, looking forward, we are hoping that it will be hopefully sometime next week that we'll hear from the province in terms of what's happening with stage 2. So stay tuned for that. And today's webinar, it's a very timely one. We've got two experts, two Roberts from TD. We've got Robert Rumfeldt, who's the District Vice President, TD Commercial Banking, and he's the District Vice President for Southwestern Ontario region. And we also have Robert Both, who's the macro strategist with TD Securities. And they're here to provide us an outlook of the Canadian economy. What they can see, what is the perspective, and what is the future going to look like. So that is something that we're going to be listening from them. It's going to be a very interesting topic. They'll be touching upon many different issues, including how the labor market will be looking like. We've seen record unemployment in the Windsor-Essex region. We are about 16.7. Ontario and Canada is roughly 13%. This is unprecedented. These numbers are very high. So what is the future going to look like? What is it, how's real estate going to look like? What is the household debt going to be looking like? Inflation numbers, what is trade, international trade going to look like? There has been a lot of protectionism out there, a lot of countries erecting barriers to trade, and how is that going to affect us? And that's going to affect Canada and the local economy. And then the outlook for the Canadian dollar, interest rates. So there'll be some very interesting topics that Robert is going to, to touch upon. So I'm really looking forward to that. This will be a very interesting session. So take this forward and to do an introduction of Robert Both, I invite Rob Rumfeldt to take it from here. Rob, all yours.
Well, that's great, and good afternoon. And as Rakesh mentioned, my name is Rob Rumfeldt, and I'm the District Vice President for TD Commercial Banking. So a quick welcome to our TD Commercial Banking clients and as well Chamber members. Thank you for taking some time today to attend. I also wanted to extend my appreciation to the Chamber of Commerce for hosting TD Commercial Banking today, and in particular Marina for all of her assistance. So a quick update on our team. We've been working from home since roughly the end of March, and we're very fortunate to have some great technology, which has allowed us to stay connected with our clients and even onboard new clients. We've seen lots of activity, whether it be discussion on an operating line extension, principal deferral on a term loan, a lease, a mortgage, maybe it's a CEBA loan, or maybe it's a discussion on the wage subsidy, or perhaps one of the BCAP programs. In particular, while many of our branches are still open in the community, we have seen a tremendous increase in what I call cash management services, with many of our businesses looking at new ways of electronically collecting and dispersing their funds. So I would certainly encourage anyone with any questions to reach out to their account manager or relationship manager, as we are open for any business banking advice or guidance to any of our many banking partners. TD, despite unique times, we are very much open for business. So I wanted to introduce our guest speaker today, Robert Both. Robert is a macro strategist with rates, FX, and commodities research team at TD Securities in Toronto. Robert has been with the team since 2015 and provides research and analysis on the global economy and financial markets to a wide range of institutional fund managers and commercial clients. Robert's focus is on economic conditions across North America, and he contributes to the bank's economic forecasts and central bank analysis. Before joining TD, Robert completed his Bachelor of Commerce degree at Dalhousie University, where he graduated with a major in finance. So with that, I'll turn it back over to the other Robert.
Thank you, Robert. And thank you, Rakesh, and to the Windsor-Essex Chamber of Commerce for having me here today to speak to you. So I'm going to speak about how COVID-19 has impacted the Canadian economy, what we're seeing in the economic data, how policymakers have responded, and what we can expect going forward. So if we back up a little bit and look at where the economy was heading into 2020, the economy was in a pretty good place. Global trade tensions were showing signs of a thaw after years of escalation between the US and China. The labor market in Canada was the strongest we'd seen in decades, and the federal government was carrying relatively little debt compared to its international peers, and provincial governments were also making headway at reining in their regional deficits. So when we say that the economy was in a good place, I think we can equate that to being in sort of a steady almost state. So as we know, that changed quite abruptly in late February and early March. The WHO declared a pandemic on March 11th, but by then it was already evident that coronavirus was going to have a vast impact on local economic conditions. In January, we had already seen significant evidence of the type of disruptions that can occur in China, but most of the local concerns were around how this would impact US-China relationships in the recently signed Phase 1 trade deal, which included targets for US exports across certain product categories. Once we began to see community transmission in Europe and across parts of North America, this evolved into a different sort of crisis for us with much more tangible implications for the local economy. So since early March, we have seen a rapid deterioration in economic activity. And 2 to 3 months later, we're still trying to quantify a lot of that. The reason is that the data collection process takes time in Canada. Compiling the national accounts to produce an estimate for GDP takes about 8 weeks from when a month or quarter ends. And even reports that are more focused on a specific sector, such as manufacturing, shipments, or retail trade, those can take about 6 weeks to produce. So in a typical slowdown where activity declines at a more gradual rate, the consequences of waiting for some more clarity are much smaller than in the current environment. In a sense, we are operating in a void because we have yet to confirm how severe the initial slowdown was and to what extent things have recovered over the last month to 6 weeks. So we have only just received the national accounts or GDP data for Q1. And while historically weak, things were not quite as bad as initially feared by ourselves and others. So the time it takes to collect all of this data puts a premium on more timely sources such as surveys like the labor force survey, even though they can be less informative and more volatile than GDP. COVID-19 has also led to some innovations on this end. So since the crisis began, major technology companies have been providing mobility data collected from GPS on mobile cell phones. This tells us how many people are taking transit and driving on a daily basis, and also allows us to track visits to different types of establishments like retail locations or office properties. So while it's difficult to say how well this type of mobility will translate into increased economic activity, more visits does not necessarily mean more sales. It's still important to track these as a barometer for potential economic activity and to monitor the relationship between general mobility and new infections as more people stray outside of their homes. So what we're seeing from the data, be it GDP, survey-based employment data, or the high-frequency mobility data. I'll start with the later. So mobility trends from Apple and Google have shown a steady increase in the number of Canadians out on the move. Within a couple of weeks, the emergency measures being enacted in March, the volume of cars on the road was down about 60% from typical levels, and major transit systems across the country were operating at about 20% capacity. At the same time, the location-based data showed a sharp pullback in the number of Canadians visiting retail outlets, workplaces, and a larger increase in the time spent in residential properties. So what we saw in April was these trends started to improve even before individual regions entered the phase 1 of reopening, or whatever the equivalent was in their province. There are now about as many cars on the road as there were in January and February. And while seasonality might account for some of that, certainly it's much more pleasant to drive in June weather than it is in the winter months. That is still a very encouraging sign of progress. Public transit remains about 60% below where it was a year ago, but that is still a significant pickup from where we were a couple months ago as well. So there have been signs of encouragement on that front. And if we focus on what we've seen in the actual or the administrative economic data, that is that which comes from official sources, we're still getting data from the early stages of the crisis, but like I said, things have been not as bad as initially feared. Gross domestic product fell by over 7% in March, even though the first 2 weeks of the month were relatively less affected because of the rapid acceleration in conditions through that period, that is still a little bit better than estimates were before those numbers were released. Retail trade fell by about 10% that month. Manufacturing shipments fell by 9%. That is particularly important in the Windsor-Essex region because the manufacturing slowdown was heavily driven by auto production, a key driver of employment and investment. So most North American plants shut down in the last 2 weeks of March and did not restart production until May. Since then, it's been a rocky few weeks for some because of supply chain issues further down the pipeline. Now, even though we had not reached the low point for actual activity by March, the 7% drop from February was larger than the peak to trough decline through the financial crisis. And early indications suggest that activity fell by about another 11% in April. So this does take us back to a level of activity that we haven't seen in some time. And in terms of the peak to trough impact, this is a fairly unprecedented crisis that we're in. So we haven't seen much official data for the months of April and May, but what we have seen has been somewhat encouraging relative to some of the earlier estimates that were put out by ourselves and others. So the international trade data hasn't been so great, but I'll pivot to the labor market since that gives us a more timely indication of where things stand. There's good news and bad news to report on this front, but I prefer to end on the good news. So I'll start by noting that the Canadian economy lost 3 million jobs over March and April, which has pushed the unemployment rate to record highs. And this, even with these pretty shocking numbers, this actually understates the actual impact. 3 million jobs lost is somewhat of an understatement because there are many who are still classified as employed but are no longer working their usual hours, whether they be furloughed or just working a much shorter work week. If you include the latter, Statistics Canada has put an estimate of 5.5 million for the number of impacted individuals. Now, that's a lot closer to what we've seen on the emergency response benefit applications. And also, if you just compare that to the size of the Canadian labor market, there are only about 20 million working age Canadians in the labor force. So a really severe and a severe impact, and also severe in how quickly it hit, just given that this has all occurred in 2 months. There's also a discrepancy that shows up between the number of jobs lost and the number of hours lost. So while that 3 million Canadians represents nearly 15% of our labor force, hours worked have actually fallen by 27% if you account for the shorter work weeks. The unemployment side of things is also understated because there are a large number of Canadians who are out of work and simply stopped looking for a job. So these individuals are not counted as unemployed by Statistics Canada. What we say is they've left the labor force. So if you treat those individuals as unemployed, the current unemployment rate would be sitting somewhere near 20% across the entire country. That's not a manipulation in itself, but just a side effect from how that data is collected by official sources. Alternatively, we think a better way to look at the employment picture right now is the ratio of those employed to the working age population. We call that the employment rate. So while the unemployment rate is at 13.7% and just a few tenths over previous record highs, that ratio of the number of employed people to the total population is about 3 percentage points lower than when the previous highs on unemployment were registered. Put differently, just about 51% of working age Canadians are currently employed. Now, if we want to pivot to the good news, the May data has confirmed that the economy has turned somewhat of a corner. And that means that the peak impact from coronavirus is hopefully in the rear view. So the economy added 290,000 jobs during the month of May. And if you include those who simply worked a greater number of hours, that 290,000 would be more like 550,000 jobs added. So the unemployment rate remains at record highs, but any increase from April to May is actually a positive in our view because it shows that more Canadians are actively looking for work. There is still some uncertainty around how these employment numbers will translate into economic activity. It's not always a one-for-one relationship, and this is the data tends to be of a lower quality because it's based on a survey of Canadian households, and that sample may not fit the broader population quite as well, especially when you can't do door-to-door interviews anymore. But it does give us some confidence that we are moving to a different phase of the coronavirus crisis, and that is the recovery phase. So the regional breakdown of those job gains show that most were added in Quebec, which obviously was one of the first provinces to begin reopening businesses. That gives us a little confidence as well that we should start to see those gains spill out across different provinces as we move into June and July, as more and more regions begin to reopen and allow more businesses to operate under modified conditions if needed. So those early signs of recovery have been aided by unprecedented levels of fiscal and monetary support. On the fiscal side, the federal government has introduced about $150 billion in direct stimulus measures. Those are split between households and businesses. So on the household side, you've got the emergency response benefit, which is budgeted for about $60 billion in support over a 4-month period for affected individuals. That could be extended. Discussions are ongoing right now, and if it is, the Parliamentary Budget Officer has suggested that it could cost up to another $60 billion if we want to carry it forward to 2021. And on the business side, you have the forgivable portion of the Canadian Emergency Business Account, and you also have the wage subsidy, which, while it's being paid to businesses, it really is to support households. In addition to that $150 billion plus in direct fiscal stimulus, you have another significant avenue of support through liquidity measures. So that totals up to $300 billion right now, and it includes a substantial allocation to purchase insured mortgages from Canadian banks if we do see the housing market come under strain. Thankfully, that hasn't been tapped quite yet. But there is also significant liquidity extended to Canadian firms, be it through the non-forgivable portion of the CEBA or other borrowing measures, and also tax deferrals, which have really helped provide some relief as well. So I would be reluctant to say that we've seen everything we're going to from the federal government. There is certainly parts of the economy that are still under strain, and there are parts of the business community that have yet to receive substantial relief. But they have been very quick to get a lot of these policies out the door, and in the CERB especially, get those funds to households that need them. On the monetary side, the Bank of Canada began to slash rates in early March, about a week before the WHO declared a pandemic. So since then, they have reduced the overnight borrowing rate by 1.5%, taking it back to its 2009 post-crisis lows of 0.25%. The bank has also introduced a number of unconventional policy measures which weren't required in Canada through the financial crisis. So in addition to cutting overnight rate, they have introduced large-scale asset purchases, or QE. So the Bank of Canada is currently buying a minimum of $5 billion Government of Canada bonds per week. this helps relieve some strain in markets, and they will continue to do so until the recovery is well underway. There are other assets they have targeted for purchases as well. They have committed to buying up to 50 billion in provincial bonds and 10 billion in corporate bonds. So there is going to be some support for those provinces who are forced to issue quite a bit more over the next 12 months because they're facing revenue shortfalls, much like the federal government. Going forward, there's still a tremendous uncertainty around the pace of the recovery, but even with a significant rebound in GDP, we still expect economic output will not recover to pre-coronavirus levels until 2022 at the earliest. That's including a very significant rebound over the second half of this year. So we saw a gross domestic product fall by 8.2% annualized in the first quarter. The expectations for Q2 are something significantly worse. The market consensus, which is the median estimate among the forecasting community, points to something in the range of a 40% decline for Q2, which is going to be by far the largest drop on record. And even if you do see some quarters of growth over and above 10% annualized, it is going to take a very long time to sort of crawl out of that hole. So we do not think this will be a V-shaped recovery. For it to be a V-shaped recovery, output would have to recover nearly as quickly as it fell, and that clearly isn't going to be the case with the current crisis. Not only do we have capacity limits when companies try to return to business, but you also have a period of monitoring for an increase in infection. So it's going to be a very much feel as you go approach to reopening things. And that will dampen any expectations for a V-shaped recovery. Instead, what we're going to see is probably something that more resembles a U-shaped recovery, which is where you have a period of subdued economic activity before things recover. That would be a preferable scenario to an L-shaped recovery, which is where you have a sharp drop and things just sort of take a really long time to get back to normal. So it's very difficult to say what the next few quarters will look like because we have a hard enough time seeing what May and June look like right now. Everyone is operating in somewhat of a void for information, and we are having to revise our forecasts as we go along. And so far, there have been some signs of progress, but I think we also have to remind ourselves that this isn't going to be a rapid bounce back, that it is very tough to get back to any semblance of normal until you have a vaccine and you're able to deploy that on a mass scale. So for those reasons, we think it will be until 2022 that things return to their pre-coronavirus levels. And I guess with that, maybe we can open it up to some questions.
Yeah, thanks, Robert. Thanks for providing that overview and that insight. And the 2022 is quite some time away, and clearly, you mentioned and the others have mentioned that it's not going to be a V-shaped recovery. So between now and 2022, a lot will need to be done to support communities, to support the economy, to support individuals. You mentioned about $150 billion that the government has already put in, to support the economy and kind of a stimulus package, and more will need to be done. So I'm wondering, by the time we get to 2022, with the increased amount of spending that the government will have to do, increased level of debt that will be on everyone, whether it's individuals, businesses, province, feds, everyone, more debts. Should we be wary about tax hikes? How is this all going to be recovered? Someone somewhere is going to say, okay, time out. We need to do something about it because we just can't keep spending. What is the recourse that the government has? how do they start planning for recovery and managing the deficit and the debt?
I think, yeah, that is certainly going to be a concern, but I guess right now there are larger concerns. So that will be something that comes under scrutiny once the economy is well into the recovery. But right now, we haven't seen any confirmation of that. And we likely won't until we get Q3 GDP numbers released in November. So there is going to be a period where the government has to continue to provide that support unless we see evidence either through the labor market or internal government data that we are on a much better trajectory than we thought we would be on. So if you talk about the overall debt levels, they are quite staggering. And if you look at what the 2020 borrowing program might look like, but we are in no means a unique circumstance. This is something that every government across the world is going to be faced with. And I think before you start to talk about tax hikes or trying to reduce the deficit or overall debt, you just have to think about how to maybe get off the programs you are on right now. That is, we need to see some sort of off-ramp for some of these emergency measures as we get more confidence that we're moving past the worst part of this crisis. So I mentioned that the CERB was only built to pay out 4 months of support for those who started to collect paychecks in March. They are coming up on that closing period of eligibility. And other measures such as the CEWS or the commercial rent assistance program, those were also sort of designed to bridge a period of 3 or 4 months. Now, I don't see a scenario where we can get rid of all of those programs at once. I don't think we'll be there by July. But there may be scope to either renew them or scale them back in some other way to provide more stability to the fiscal outlook. So we're looking at a budget deficit somewhere near $260 billion for the current fiscal year. It's very likely that number will continue to grow. As I mentioned, there's a $60 billion estimate for the price tag on a CERB extension, which would easily push us over $300 billion. And when you compare that to the deficits around 2009, it certainly seems like this wasn't ever going to be possible in Canada, if you think of what a previous worst case scenario looked like for the federal government. So I think when you talk about sustainability and trying to pay down that deficit first, we really need to focus on how to transition people off of these programs without necessarily putting them at extreme risk, those families that are more vulnerable or those businesses that really require the support right now.
Thank you. And talking about support, these programs have been very helpful. I think there is a need for us here in this region to see some support come for manufacturing sector, which is the core sector in this region, and in many other regions from here all the way to Oshawa. So we are really advocating hard with the provincial and the federal government to come up with some sector-specific support, specifically for advanced manufacturing and for the auto industry. What are your thoughts in terms of what's happening with the auto industry in terms of the sale volume, and where do you and how far do you think it will take? How long will it take for this particular industry, to get back to pre-COVID level?
I think for the auto industry, in particular, maybe the outlook for production and sales look a little different in Canada. And the reason for that is Canadian households are still under a tremendous amount of household debt. So one of the aftershocks or the consequences of this crisis, once the economy is well into its recovery phase, may be that Canadians adopt a higher savings rate going forward. So that was one of the legacies of the 2009 recovery. It was that it was largely propped up by the Canadian consumer. So for the last 10 years or so, consumption has outpaced growth in other parts of the economy, and eventually that will have to unwind to some extent. So that's something that is going to weigh on the outlook for auto sales in Canada, as well as the outlook for housing. On the production side, it's always been dominated by US demand. And we don't produce any forecasts for that in-house, but IHS Markit, which is a large analytics firm, has cut its sales outlook for North American auto sales to 12.2 million roughly, which is down about 25% from 2019. So there is going to be a tremendous strain on the industry. You have 2 months of production shutdowns, obviously, that are going to disrupt the dealer inventories for specific models. And there's still a lot of uncertainty about how things are going to start back up on the production side, both based on demand, but also on the unique health risks, I think, from operating a large factory, which may be dependent on components from various countries. So everyone is sort of looking at these potential supply chain bottlenecks, and that's something that individual companies are going to have to plan and account for. But I do expect it'll be somewhat of a sort of a rocky to start up for a lot of major manufacturers. And on the support side, I would certainly echo that there needs to be more support for large industries across Canada. I don't think manufacturing or auto manufacturing specifically is the only one. I also think of airlines. I think of the hospitality industry, restaurants and hotels, and also the energy sector. And one of the things we heard back in March and April is that there would be help coming for the energy sector when prices collapsed quite precipitously. But over time, I think that has sort of evolved into what we now know as the LEAF program, or the Large Employer Emergency Financing Facility. So that is something that will effectively act as a lender of last resort policy in Canada, because the government has attached fairly high lending rates to it. It comes with a lot of strings attached, and it really is a last chance measure for a lot of those companies who might apply for it. So it would be, I think, ideal to see some sort of support that didn't hinge on a company sort of being in extreme duress before it applies.
Mm-hmm. Yeah, and I think that would be key. Timing would be very, very important. We've learned it from experience in 2008, 2009 crisis. When the government did come out and bail out the industry, there was a package that was prepared. Unfortunately, by the time that was prepared and that was put into action, quite a few suppliers collapsed and they could never come back. So I think we need to learn from that experience and time the, whatever support that is being developed, we need to time it right and provide it to the companies well within time. A lot of small, medium-sized businesses that are part of the supply chain within the auto industry, they are in a very difficult situation, and many of them will not, once they close down, they'll not be able to come back. Hence, providing that package and providing that support and that stimulation package is extremely important. Timing is extremely important there. So talking more about the auto industry, this industry is very tightly integrated. It's a globally integrated supply chain that this industry relies on, just-in-time manufacturing and components coming in from suppliers that are spread all over the world. So with this, the supply chain has definitely been very much affected and disrupted. And there is also a lot of concern in terms of, continuing the supply chain as it was earlier on, where there was a significant amount of sourcing that used to happen from low-cost countries like China. With some of the trade barriers and protectionisms that are now coming up in different places, and also some challenges and reservation in terms of doing business with countries like China and others, in not being again in a situation where we have to rely uh, significantly on these countries for our own need. There is a shift and there's a growing interest in terms of reshoring and in terms of bringing back our companies and bringing back the technology that was outsourced. What do you think will be the impact of this? At one end, buying local, supporting local company is growing in importance, and there's a huge support that is increasing by the day. And on the other end is Canada, which is a country that is that relies on trade, that relies on imports and exports significantly. How will that work out? One is dealing with the challenges of sourcing and outsourcing to countries like China, and then on the other end, balancing the need of the country, which is to continue to export and import and continue to do trade.
It's certainly an important question for Canadian manufacturers, and I would also maybe note that this trend towards deglobalization that has certainly been heavily impacted by coronavirus, that's something that predates this current crisis, and we started to see traces of before the 2016 election. Obviously, it's accelerated a bit since then. You saw declarations to rip up NAFTA if it weren't renegotiated, the US exiting the TPP agreement, and also just a really extreme difficulty to get any sort of trade agreement passed. But I think for someone like Canada, it probably doesn't impact us as much as it does others, just because trade diversification has always been such an issue for us. We had about 75% of our exports bound for the US for the last 10 or 15 years, and that really hasn't changed a tremendous amount, even when we did officially become part of TPP and CETA, or the Comprehensive Trade Agreement with Europe. So I think that'll be something that is felt more broadly in other parts of the world that don't have such a large exposure to their southern border. And if there is sort of a local or a regional onshoring of US manufacturing activity, I think that's something that would have more positive impacts for Canadian manufacturers. Now, buying local is obviously it's obviously something that benefits a lot of local Canadian businesses, but at the same time, that sort of deglobalization and nationalistic approach can be negative for longer term growth. Reestablishing local supply chains, it takes a lot of time and effort, and often involves a higher cost, which is ultimately passed down to the consumer and weighs on consumption of other goods and services. So over the longer run, if you see that continue, it would probably lead to a slightly lower pace of growth going forward. But at the same time, if that were a regional trend and the United States started to onshore more of its manufacturing production across the North American area, that would be something that certainly provides a lot of support to businesses in and around southwestern Ontario.
Mm-hmm. Talking of businesses and in sectors, not just in Ontario, but elsewhere in Canada, what are some of those sectors you think will deal with this situation better and will come out stronger post-COVID? Once say we are at 2022, what are some of the sectors you see will be the ones that will be strong in?
So I think you can sort of separate this into what are the industries that'll benefit from the crisis we're currently in, and then what are the industries that would benefit from the economic recovery. So for the former, obviously, this has been a tremendous opportunity for a lot of technology companies. We recently saw Shopify become the most valuable company in Canada, worth more than any major bank. So that is certainly something that a company that received a tremendous amount of business from having all of these small local businesses build web platforms, and just broader cloud computing, and especially, providers of the video conference that we're on right now. These are all industries that will benefit from the environment we're in. I think as you look further out into the recovery, it will be something that benefits a lot of construction firms. There's still a lot of uncertainty around what the residential construction outlook looks like, or what the housing outlook looks like. But infrastructure has long been a pillar to support economic recovery, because it tends to pay off better than other programs over the long run. There are reasons why infrastructure isn't as effective right now at providing some relief, just because it takes so long to line up projects and get shovels in the ground, that if the government had announced $73 billion of infrastructure instead of the CEWS, obviously I think less than 10 billion would have been spent by now. But going forward, that is an industry that will receive a lot of support. There are others that are going to continue to operate in a more challenging environment. The hospitality one is one I mentioned. That is something that's very difficult to see them returning to 100% capacity until we have a vaccine. Until then, you are going to have to operate with some strict capacity limits, and a public that may be less inclined to go out for meals than they used to. Others, like commercial real estate, are also going to be having to analyze how much demand there is once things return to normal, just because this sort of this grand experiment of working from home, I think, has caught a lot of people off guard at how well it has actually worked out. So. Very true,
very true. You talked about construction industry, tied to it is the real estate industry. And in the Windsor-Essex region, the last few years, we've had a really good run, with record increase in the average sale value and number of sales units and so on. And then the main numbers actually came down, which is, dampened a bit, but still on the positive side. Our growth was roughly about 14% in terms of, the number of sales, and the transactional value, the average sales value actually went up by a certain amount. I don't remember. I think it's between 48 to 50,000. So that's a good sign. It is not as the rate is not as much as it was, but still growing. So the Windsor-Essex region is still a great place for real estate industry. What are you seeing in terms of what's happening with this industry in Ontario and rest of Canada, and what do you see the future of real estate industry?
I think Toronto and Windsor were in a similar environment for the last few years. Maybe Toronto has been hotter for a little while longer, but it certainly is going to be a lot more challenging for the housing market going forward. One of the key drivers of the housing market in Canada, and one of the key factors that everyone has been proven wrong when they call for a decline, has been the importance of immigration in driving housing demand. So international immigration accounts for roughly 60 to 70% of Canadian population growth over the last couple of years. And a lot of that has been driven by economic class migrants, ones who are coming to Canada to start a business, or coming with that economic skill set. So it remains to be seen whether Canada will be as attractive to the international immigration going forward, and that will be a key factor in what happens to the housing outlook over the next 2 or 3 years. I think in the near term, you're absolutely right. We saw a similar bounce in May for Toronto home sales. And I think there have been a lot of buyers sort of on the sidelines for the last 2 or 3 years, just because affordability has been such a concern here that when you did see a bit of a slowdown and, sellers getting a little more motivated and entertaining lower offers, I think that there were a certain number of people who were willing to take on that risk and enter the market. The federal government, through the CMHC, has also recently announced that they are going to tighten the lending criteria for first-time homebuyers. So that'll certainly act as somewhat of a break or have a cooling impact on things. But over the long run, it may just help prevent further vulnerabilities from building up, because household debt is certainly still a concern. And if it weren't for the mortgage deferrals that are being offered by TD Bank and others, then the situation that we're currently in would be a little more dire. But the hope is that by September, when those deferrals expire, that many of the affected individuals will be back to work.
Right. And what's contributing potentially to an increase, and where I think the first-time home buyers and the others may be very interested at this time, is the low borrowing rate, right? The overnight, you mentioned the overnight borrowing rate is 0.25%, which is quite low. And I've heard of some mortgage companies and banks offering fixed 5-year fixed term at 1.99, which is very attractive. So if there are people in the market who've saved enough, to put a down payment, and if they're in the market, I think this is a great time for them to buy.
Yep, there are certainly a lot of renters who have been priced out of the market. But we may need to see confidence recover a little more before everyone rushes in. Agreed.
So tell us about where do you think our dollar is going to sit in few months from now? Currently it is trading at 74.10 US cents. What's the trend going to look like? Do you think the dollar is going to appreciate versus the US dollar? Where is this all going to head to?
I think over the medium term, the Canadian dollar is pretty fairly valued right now. In the earlier stages of this crisis, where the Canadian dollar was closer to 70 cents, that would provide a bit of an incentive for Canadian exporters. But it's obviously difficult to take advantage of that when there's no demand from the rest of the world. So our medium-term forecasts are relatively close to where the Canadian dollar is trading right now. And I think over a shorter term, the Canadian dollar may actually be a little overvalued, just because there is still a tremendous amount of uncertainty out there over what the economic recovery looks like. And in those periods of uncertainty, capital tends to flow towards the United States and other safe havens. So that is something that would have a depreciating effect on the CAD, and maybe give a little bit more of an advantage to Canadian exports. But I think over a longer term, that should sort of fizzle out once the recovery becomes more solidified.
Mm-hmm. Right. Being a border town, we are always very interested in knowing what's happening. Border is closed for now, but when it opens, we'll find a lot of American buyers that come into the Windsor-Essex region, and a lot of Windsor-Essex people travel to US for multiple reasons. So this is an industry, this is a region that gets impacted significantly by the exchange. Also, a lot of our manufacturing companies, they quote in US dollars. So any fluctuation of the US dollar impacts our businesses quite a bit here. There is a comment in the chat box. I think they're asking you made a comment on immigration and how that helps, construction industry when, when immigration happens. And I think they wanted to clarify whether it is immigration you're talking of, or you're talking of foreign investors.
So I was referring to immigration and non-permanent residents are a significant driver of that. So they are actually residing in Canada and living in Canada, but they don't have that permanent residency. So students have been a significant driver of those. A lot of international students study in Canada. They wouldn't be classified as a foreign investor if they were living in the unit. And those are the what I was referring to. Foreign investors, they're another source of demand, but I think over the 2016-2017 period, it was somewhat overstated the impact they had on the housing market. There wasn't a lot of data on the residency status or whether or not someone was living in the home. We started to improve that once it became more topical. And what that showed was even in cities like Toronto and Vancouver, where you have a larger share of investors, it was still a very small number. So I think it was more of a factor in maybe driving domestic speculation.
Mm-hmm. Great. Well, thank you, Robert. We're just about made it to time. I really want to thank you, and Rob, you as well, for making time and for sharing your insights. Nobody has a crystal ball here, but you did a really good job in terms of identifying, the trends and what we're likely going to see in the coming days and in the coming months. So this is really important for us because, the more informed we are, the more informed the businesses are, the better decision they'll take, and the better and the faster will be their exit out, and the reopening will be much smoother. So we appreciate you sharing a lot of good information here. This video is being recorded and will be made available on our social media sites, on YouTube, and will be on our website as well. And for those of you who are listening in, if there's any question that you wanted to ask but didn't get a chance, please send it over to us. We'll make sure that we turn it over to both Roberts, and we'll get an answer from them. And we encourage you to, to continue to come back and join us for the webinars that is coming up. We've got next week, we've got a few really good events, that we have planned for you. We've got on the 16th, TMT Prediction, which is Technology, Media, and Telecommunication. It's a presentation done by Deloitte. Fantastic topic. We'll talk about what to expect now in the COVID-19 era and how things will change. Then on the 17th, we have Minister Vic Federley, who will be coming here and sharing with us what's happening in the province, what they're doing to support the economy, the business, the sector that we have here, or the sectors that we have here. So that will be a great interaction with Minister Federley. And then on the 18th, we will be talking specifically about Bill 145. This is something that is affecting the real estate industry. So we will dive into it a little bit more. And then on the 23rd of June, we have a virtual Windsor-Essex Wake Up event where you can come and talk about your companies and share information with the rest of us in the community. Great opportunity for you to profile your business. So if you need information on any one of these, please feel free to reach out to us. You can call our number. It's it's on our website, or you can send us an email at info@windsor-essex-chamber.org. So with that, I want to thank each one of you for being here. And again, thanks to Rob and Robert for making time for this. Appreciate much. And great appreciation for TD for being such a great partner. TD here is a member of the chamber locally as well. And we appreciate all the support that you provide to the chamber. And events like this, where you bring your expertise, is very much valued by us and by our members. So once again, thank you. And take care, everyone. We will see you again next week on the 16th. Take care. Bye-bye.